Hey everyone, this is Ben Whitty here to talk to you about inflation. What is everyone saying? What's actually happening? And how does that affect every single person with a mortgage? So you've been hearing a lot in the news about inflation, followed by a story about increased gas prices or the increase in housing costs, and you're likely seeing it in your everyday life. Going out to eat costs a lot more. Maybe you went to the hardware store to grab some 2x4s for your next and hopefully last COVID project. And the cost of lumber was absolutely ridiculous. But what is exactly causing the prices to rise, and how can we measure what is happening? It seems intuitive that as the Fed prints money, it becomes less valuable, right? But that is only a portion of the situation. Most economists would explain inflation in layman's terms as too much money chasing too few goods. So while you're right that money flooding the system devalues it, we must also take into account the fact that there are also massive shortages of goods in the economy as a whole. There's also a third factor that people never mention, and that's the cost of compliance, which we will get into that on another video. So how is this stuff measured? Well, the current regime measures this stuff by what's called the core CPI, which means Consumer Price Index. It takes all of the consumer goods, weighs them, puts them in what's referred to as a basket of goods, and the price of that basket of goods measures the purchasing power of whatever currency you are measuring, and in this case it's the US dollar. Now, these movements may seem small, but as they track the numbers from month to month, and usually fluctuate around 0.1 to 0.2%. They take all the numbers over the last 12 months and add them up, and you have, boom, your core CPI. When the averages are normal, you typically see inflation rates around 1.8%. But that, according to Jerome Powell, who is chair of the Federal Reserve, he is trying, quote, as hard as he can to get the numbers above 2% over the 10-year average. That doesn't sound like much, but let's take a look at what that means. Here are the CPI numbers month by month. And as the latest report came in last week, the numbers came in at 0.6, which is about 4 times more than the actual average we talked about earlier. But if you look at what the accumulated number did since last March's numbers dropped off, which was negative 0.3, you see an increase in CPI of 0.9. So the core CPI went from 1.7 to 2.6 in a matter of 30 days, or about a 50% increase. Now, if you look at next number to fall off, it is last year's April number, which, and this is what I would call a negative outlier. This is huge because let's try to remember what was happening at this time last year. Restaurants were shutting down. Broadline food distributors like Sysco and US Foods were stuck with all of this perishable inventory that they had to get rid of. So they sold it all for pennies on the dollar, and to pretty much anybody who would take it. We stopped taking imports from overseas, entire distribution chains were disrupted, realtors couldn't show houses, so nothing was coming on the market. It was a big mess. And there was basically a month-long deflationary period many businesses couldn't open for and were trying to liquidate their inventory. But this negative number is about to fall off the core CPI, and as it does, it will be replaced very likely by a number that is greater than 0. And even if conservatively this next month's report comes in at, say, 0.2, we are going to see an increase in the core CPI of, yet again, 0.9%, which brings the annual inflation rate to 3.5%, an increase of over double in just 2 months. You might be telling yourself, I know this, I can feel it everywhere. Things are more expensive. My utility bill is going up, gas prices are going up, housing prices are out of control, the cost of tuition is going up even though I'm not allowed on campus. And you are correct. But the real kicker is that energy, housing prices, and education are all things that have been intentionally withheld from the Consumer Price Index. So while the CPI is up to 3.5%, the cost of gas is up 30%. Housing prices are up 12%. And I don't even know about education because that's not in my purview. As inflation rates rise, we ask ourselves how that affects mortgage rates. Well, the interest rate on a loan is simply the cost of borrowing money. And as the cost of everything increases, that also includes the cost of borrowing. The Fed could set the short-term interest rates, but the banks will need to still make sure that their interest rates are higher than the rate of inflation. They're not going to loan money out of a loss, right? And the decreased buying power of that money means that they need to charge more for it. so rates will steadily increase over time, with or without the Fed. They have a few tricks up their sleeves that they can deploy to tamper down rates temporarily, but pretty much all of those strategies include printing more money, which is kind of like being stuck in a hole and trying to dig yourself in an upward direction. Rising rates are not the end of the world, though. It is extremely low rates that are causing the housing prices to rise so incredibly quickly. So if the Fed does decide to take its medicine and let the market equalize, which I kind of doubt actually, but let's say that they do, that is exactly what you will see. Rates increase only slightly, and that causes housing prices to level off and appreciate at a more sustainable level. Could you imagine if housing prices appreciated 12% every single year? I don't know. Seems like a nightmare territory for me, but thanks everyone for your time. This is Ben Witte. Any questions, or if you want to see what you can afford in a new house or a mortgage, you can go to my link to my website that's in the description, and I'm going to be doing these regularly, so feel free to hit me up with any topics you want me to discuss, and I'd be happy to do some videos on some popular questions that I'm getting. Thanks, and let's change your money paradigm.